Welcome to the CHSA designee update. This is really part two of last week's look at the actions taken by the House of Representatives in passing a couple bills that would improve health savings accounts and high deductible health plans. Last week, we focused mostly on contributions and eligibility. This week, the major focus is going to be expenditures and the transfer from a flexible spending account into a health savings account. So as I mentioned last week, the House of Representatives passed on a bipartisan support H.R. 6311 and 6199. 6199 had more Democrat support than 6311. So let's take a look at some of the changes, some of the additional changes that we didn't discuss last week. One of the first things is that an HSA that is opened within 60 days of a high deductible health plan being put in place or gaining coverage under a high deductible health plan, the individual is able to have this grace period, if you will, to be able to go back and actually use the HSA for expenditures they may have had. The example or the concern is that, someone may move to a high deductible health plan and not open their HSA immediately and incur some costs, and then be forced to pay that amount under the deductible on a after-tax basis. So this would give a grace period from the time in which the health coverage began, give you 60 days in which to be able to have a clawback, if you will, on the health savings. A direct primary care service arrangement is a situation in which a patient and a physician enter into a contract to provide unlimited primary care services for a retainer fee. Currently, under current law, a DPC service arrangement is considered to be a disqualifier from someone being able to contribute into an HSA. It's looked at as almost another form of insurance. In addition, you can't pay those fees through your HSA on a tax-preferred basis. The bill that was passed out of the House last week would actually allow for DPC service arrangements to not disqualify someone from contributing into an HSA, and would also make the payments up to $150 aggregate a month on an individual, or $300 a month on a family, to be treated as a qualified medical expense. So you could pay those fees through your health savings account on a tax preferred basis. Another change in the bill that was passed last week is that it would allow for certain over-the-counter medical products to be considered an HSA qualified medical expense, which was the case prior to the passage of the Affordable Care Act. It would just reverse that ruling back to prior to the Affordable Care Act. Another change when it comes to expenditures in HSAs is that the bill would allow for certain fitness-related expenses to be considered an HSA qualified medical expense, things like gym memberships. The limit for that as a qualified medical expense is $500 for an individual, $1,000 a year for a joint return. Another change in the bill is that it would allow for conversions from a flexible spending account or health reimbursement account be made into a health savings account at the employer's discretion. So at the time in which someone enrolled in a high deductible health plan, if they had an FSA or HRA balance, they could contribute that money or transfer that money to a health savings account up to $2,650 for an individual and $5,300 for under family coverage. These dollar amounts would count against the maximum contribution in a year for a health savings account. So I want to take a little bit deeper dive on this transfer from a flexible spending account to an HSA, because under current law it's really difficult, it's cumbersome and complicated, and you could really run afoul of it. So basically, employees who are participating in a general health FSA are not able to contribute into an HSA. Most flexible spending accounts run for a calendar year, and you're not allowed to make mid-year changes. So in the yellow here, we see just a quick scenario or example. We have a company, they offer their employees the option of a flexible spending account at the beginning of the year. Subsequent to that, halfway through the year, they move to a high deductible health plan as of July 1st. So under the current rules, those employees who did not elect to participate in the flexible spending account could open up an HSA and fund an HSA because they're covered under that high deductible. However, those who did elect to participate in the flexible spending account will not be HSA eligible until at least January 1st, 2019. And let's look at why I say at least January 1st. The reason I say that is because if the flexible spending account has a grace period, which is a period of up to 2.5 months at the end of the plan year to spend current unused flexible spending accounts funds or to incur new FSA eligible expenses, they would not be HSA eligible as of January 1st unless one of the two things occurred. Number one, they had a zero balance in their specific FSA at the end of December 31st, or their employer actually amended the general health FSA to be a limited purpose FSA, which would only be for vision and dental. If the individual situation doesn't meet that, he or she would need to wait until the beginning of the following month in which the grace period expired, which could be as late as April 1st. When it comes to carryovers in a flexible spending account, beginning in 2013, the IRS allowed a maximum of $500 of unused FSA assets to be able to be rolled over or carried over into the next year. In a situation like that, if someone has carried over any money or is carrying over any money into a new plan year, they will not be eligible for a health savings account for that entire year. So the carryover would preclude someone from being able to contribute into that HSA. If the FSA has a run-out period, which many do, which gives you an additional 90 days at the end of the plan year to be able to get bills in and make payments through your flexible spending account, that is allowable. You would be able to be HSA eligible as of January 1st. That would not compromise that. I hope you found this information to be helpful. If you have any questions regarding this subject, or if you have any suggestions for a future subject for a CHSA update, please contact us at info@accesspointhsa.com. Thank you.